welcome. Good to catch up with you again. Of course, we're reacting and markets reacting to that latest news announcement from Donald Trump with 25% tariffs on, well, in particular, Japanese and South Korean exports as of August 1st. What did you make of that market reaction?
Yeah, look, I think talking to a few clients, talking to a lot of clients actually were asking us what we thought of Liberation Day 2.0 coming around. The initial market reaction, I think, was soft, lower, but I think if you look at the S&P 500, it actually bounced back about 0.4, 0.5% off its lows. So, look, take it as maybe a sign of complacency or the market just kind of getting over it. But the Japan tariffs was a little bit interesting. You've got Japanese as one of the highest, I think the largest owners of foreign owners of US Treasuries. There's obviously auctions coming up. But if I look at some of the other tariffs that are announced, like some of the other emerging market companies on Laos and some of them, if you look at the tariffs that have been announced versus what was announced on 1st of April, early April, they're kind of largely there or thereabouts. So from what we're seeing in the market and the reaction is, I think, honestly, the market is fading it. They still think the bark is actually louder than the actual bite. And yeah, I think, I'm not sure if it's right, but I think maybe the press secretary announced that there's some confusion on what's happening on the 9th of July, because I think Donald Trump said, yep, tariffs are coming in. And then Lutnick came in and suggested that actual tariffs will start on 1st of August, which means countries have another 2 to 3 weeks to negotiate it. And I think all of that confusion and what is actually happening has, resulted in what you've seen in the S&P 500 initially down, but it's bounced off its lows. So yeah, that's our take on it. I think the market is still digesting it and frankly, just kind of brushing it, to be honest.
Well, I mean, this is the issue, though, isn't it? It's the lack of clarity we're getting out of the Trump administration, the impact that's having globally at the moment. So, Zach, of course, this comes at a time when markets are at all-time highs, both here and also what we've seen in Wall Street. So, what are investors likely to do? I mean, no doubt it is going to make some nervous.
Yeah. So I was just looking at the CTA positioning heading in. Clients, the positioning suggests that there was selling across the board in bonds, and there was buying in equities, large cap, and there was a bit of selling in future selling in Russell, so the small caps, which has been weak. But look, from our perspective, Andrew, this is the market reaction overnight. I think the real pain trade is in the positioning of investors right now. And sure, the retail buy, the dip guys, as we've been saying, have participated in this rally. But if you look at the institutional guys and the positioning there, as this chart shows from Deutsche Bank, it's still pretty low, well below the February peaks that we saw before the trades volatility all increased. But it's still underweight, not only being below where we were in February. So the real pain trade for us, as we see in the market, is that if things continue to kind of, settle down, even with the latest tariff announcements overnight, and then, the confusion around the deadline, when do they come in, and then eventually trade deals happen. What was interesting is the biggest trade partner in Europe, they did not receive a letter. So we don't know what's happening there. So I think the big pain trade right now is that the tariffs talk continue to kind of simmer away, but lose their bite factor. And I think overnight equity market movements may be suggesting of that, maybe suggesting some complacency. But then you look at the Europe the tax bill that's come through. Obviously, that's been signed in. That's very much pro-growth. Then you've got European NATO partners looking to up the spending on defense spending. Economic conditions, certainly in Europe, relative expectations are coming better than expected. In the jobs data in US last week came in better than expected. Both the household survey and the non-farm payrolls showed good growth, so the labor market's not breaking off. So the pain trade for us, Andrew, is this positioning that a lot of investors, institutional investors, find themselves who have to show relative and absolute performance. At some point, will have to make a call. And the issue that I want to just raise is the kind of positioning that we're seeing, both anecdotally and in the data. What you really need is a Liberation Day kind of a correction for these guys to cover some of the underweight positions. Otherwise, they're going to have to keep taking nibbles at any market correction. So that, I think, is a real pain trade here and something to worth watch.
All right. Well, meantime, interested to see where you're seeing opportunity at the moment, and particularly in the States. Home building, what are you seeing?
Yeah, look, home building's been in the doldrums. We all know the story. The narrative is very clear. High mortgage rates, cost of living issues, and then affordability issues. The Fed, which was expected to cut more than what the market was initially suggesting this year, but that's also being pulled back. So overall, I think the downside picture is well understood. But this is the home builders ETF in the US, the Spider Home Builders ETF. It started to jump up, and I've started to hear a lot more investors on the buy side have started to take nibble at home building stocks in the US, and this certainly suggests that there is a little bit of buying pressure coming through. So it's moved out of its obviously downward trend. And I think even in Australia, if you're moving around Australia, I think there is opportunities to start picking up some of these cyclically depressed stocks, which no one would probably want to touch right now, because obviously the building material sector, even the trade sector, if you talk to Metcash, if you talk to Reece, it's still pretty subdued in terms of trading conditions. But I think this is where you want to start to consider picking up stocks like home building stocks. So James Hardie is one in Australia that I think stock clients could consider starting to take nibbles at these levels. These are high quality companies with strong market positions and really good margin. I know James Hardie has this whole issue around the recent acquisition, but that's been approved as well. Invariably, over the long term, it should be accretive. And so I think this is the time you probably want to be really, really looking hard at these kind of stocks. So the recent movement in the US home builder sector, and I think maybe the signs that sort of bottom feeding investors, contrarian investors are starting to pick up some of these stocks on the cheap. So I think both in the US through the Spider Home Builder ETF, and in Australia more specifically, I think James Hardie and Reece could be early on this, but I think it could be really worth looking at those that are looking to put some money into play, which haven't already run.
Yep, and of course, on top of that, tailwinds from more interest rate cuts, particularly today, Zach, with the expectations the RBA is going to cut again.
Yeah, I think, well, that's the other part of the thematic for Australia more specifically. I think the story for your listeners may be a little bit harder for US, maybe not there because the Fed isn't really jumping on board on the cutting cycle. But in Australia, it'll be very interesting. I think initial expectation after the recent inflation data in Australia was that almost 95% will get a cut. Maybe the RBA brings forward the August cut, which was a certainty. But now the expectation is 2 to 3 cuts. We're more in the band of 2 cuts, but you get 3 cuts, and plus the previous 100 basis point cuts already, you're starting to see the lag effect of monetary policy should start to flow in, plus what we're likely to get over the course of this year from RBA. So start to really build nicely for some of these cyclical stocks.